Welcome to the Data Room, where we demystify go-to-market data for financially strategic execs. We deliver real-world guidance for finance and go-to-market teams, helping them collaborate to transform their data into a strategic asset. I'm Scott Stouffer, CEO and founder at scaleMatters. I've been a CEO for over 30 years at various tech and SaaS companies, and I've seen firsthand the power of using data and data modeling to understand what drives value creation in a business. Today's guest is head of origination at saas.group, Dirk Sahlmer. Dirk's an engineer turned M&A professional, acquiring promising PLG SaaS companies. Dirk, welcome to the Data Room.
Thank you, Scott. Thanks a lot for the invitation.
No, glad to have you here and get your perspective, particularly with all the M&A work you're doing. So you do have a unique perspective, kind of as a former founder and now kind of current M&A professional in the SaaS space. Tell us a little bit about your journey as a founder and how that's informed your work now that you're on the acquisition side.
I actually am a mechanical engineer by training. So that's how I started. I grew up in the southwest of Germany, where all the big automotive companies are. And so I thought I would do a career at any of these. Turned out a bit different at the end. I got into that whole startup space through a seminar at our university when I was doing my master's. Yeah, we went there like Friday, Saturday, and we learned about how to validate ideas with customers, how to build MVPs, and all the basic stuff you would learn probably in an early stage accelerator. And I think my team was the most ambitious one. So we really wanted to win the final pitch contest. We really wanted to develop a product, whereas the others were basically just collecting points and they wanted to have the final signature that they attended it. And we were encouraged to continue working on that project. And this was actually a parking management software. We wanted to target retailers because I was living in Stuttgart back then. It's an auto city, lots of cars, too many cars, and a lack of parking lots. And so we thought, hey, those retailers, they have like 100, sometimes 200 parking lots. If we build a software that helps them manage those parking lots, that could be something. But yeah, ultimately, I have to admit, we never got far. So we had a few paid pilot projects and a few great learnings and actually working products. But then we also had disputes in the team and so on. So we ultimately decided to close it down. But actually lots of learnings. And to your question, I think the biggest learning was that especially early stage founders, but also later stages, are often distracted by a lot of other things that happen around them, or they are attracted by that startup entrepreneurship kind of bubble because they just find it cool and they are attracted by, pitch contests and whatnot. But what they actually should do is validate ideas, talk to customers or potential customers all the time, and just quickly iterate. And so lots of learnings. And then, we decided to close it down. I was looking for the next job, basically. And I ran into a job listing of Tim, who's one of the SaaS Group founders. And he was looking for an analyst. That was the role. And the job description was basically related to deal sourcing. And I applied through a cold message via LinkedIn. And that's how I landed my job at SaaS Group. And now I've been with SaaS Group for over 5 years and have seen a lot of transactions in the meantime.
Interesting. Real quickly, what's the typical profile of the company that SaaS Group looks to acquire?
Yeah, so we focus on what we would call micro-cap M&A. So the typical SaaS startup is somewhere between 2 and 10 million in ARR, profitable, capital efficient. So I would say our ICP tends to be bootstrapped. And we also have a focus on product-led companies and not so much enterprise SaaS companies where you need to do outbound. So we are experts in marketing, and that's our muscle. And so we prefer those PLG companies.
Kind of high velocity stuff. Okay.
Yes.
Interesting. So back on your earlier point about validating your idea against prospective customers. How do you best do that? Because, in my experience over a number of startups, and we would always try to do that, unless you're actually asking them to write a check I guess the question is it a fair test? If you demo the product and maybe they even pilot it and they tell you, yeah, this is great. I mean, to what degree do you filter that, given that you aren't necessarily asking them for money at that point?
Yeah, I would especially see this in a context of VC funding and VC-backed startups, because, I mean, if you're a proven entrepreneur, then of course you may have it easier to raise rounds, but we had times where you could also raise rounds just on a pitch deck. And I would say you should never seek validation from investors, but rather the group of people that actually should fund your startups, which is customers. And so I would say just try to build an MVP. I mean, there are other terms nowadays. Some would call MVPs dead, but like build something that you can show to someone and ask them whether they would pay for it or whether you bring them to actually pay for it. And so basically try to fail fast or try to iterate fast if they give you feedback on what's missing or what else they need. A few years back, I made a joke. You could basically go to someone seeking enterprise SaaS solution and say, hey, I have a stick. Do you need that stick? Do you buy it from me for $10? And they will tell you, no, I don't need a stick. I need this. And then basically you iterate from the stick to something else. And all of a sudden you will build basically an SAP solution, whatever. But just like be closer to the customer, try to talk to them all the time. And the more you talk to them, the more you learn. I'm also against hiring like VDRs or salespeople early on and let them talk to customers, because I think especially in the early stages, you as a founder need to be the one talking to them.
Yeah, that makes sense. Do you have any point of view in terms of how many conversations with prospective customers is a sufficient sample size?
It depends on the product and like what you're trying to sell and how much you would charge for it and how big your market is. So it depends on a lot of factors, but it's definitely not 5. It's also not 10, maybe not even 50. Ultimately, the more people you talk to that are presumably within the ICP you're aiming for, the better you can validate it. And I mean, ultimately, they will all tell you something different, but your job is to condense it down to the overlaps and work on those.
Any other distractions that come to mind when you talk about the distractions that a lot of founders have, particularly kind of the conflict between serving their clients versus serving prospective investor goals? Anything else jump to mind that you've seen?
Yeah, so to give you a concrete example, I had a LinkedIn post about this some time ago. We acquired some companies with saas.group where the founder doesn't have any social presence, like no Instagram, no LinkedIn, no nothing. They are basically not present on the internet except their SaaS websites and a contact form, so you couldn't reach them. And I mean, that's the best case. Well, maybe not best case scenario, because it helps also to get sparring with other entrepreneurs maybe, but they just talking to customers. They are customer centric. They just build something that customers want, because otherwise their business wouldn't even exist. And if you look at the general startup bubble, I mean, you have investor meetings, startup meetings, conferences. You can go through your LinkedIn feed. You see, like, this is the framework you should steal to become better at GTM, whatever. So I think you can easily get distracted by all that's happening around you. And you think there's a, let's say, shortcut, but ultimately there's not. And the things you see outside are not necessarily applicable to your specific case and to your business.
When you're looking to acquire a company, what are some of the things you would see that you might view as a red flag or a warning, something that, causes caution on your side?
For us, it's important because saas.group is built as an evergreen model. So we want to acquire those companies and keep running them, keep growing them. And ideally, we work together with the founders. So what I usually do in the first call is, to be honest, I don't talk much about numbers. It's more about checking the cultural fit and see how they react. Are they actively seeking an exit? So that's like the first conversation. And then it also goes about product, marketing strategy, and just their behavior. Are they micromanagers? Are they hard to deal with? Do they have high expectations? But also then when it comes to business itself, is it super messy? Is everything super organized, clear reporting lines, all data available on short notice? it's like you would buy a house. I mean, you would go there, you would inspect it, and if you see something is wrong with the house, you might try to lower the price or walk away ultimately. So I'm trying to get a sense of how the business in general operates, and is it efficient? Is it working properly? Is it a whole mess, or is it very organized and clean? And so this is for the business and the operations itself. Then for the general efficiency, I also look like, what are their marketing tactics? What are they spending their money on? Are they tracking what the ROI of those things is? How are they tracking it? Are they wasting a lot of money knowingly, basically, with like travel costs, conferences, and so on? It's a general cost sensitiveness. Is it there? Is it not there? And then regarding the product also, does it have technical depth? Any platform risks? Like, for example, if we're talking about an app that's automating LinkedIn messaging, that might be a big risk because LinkedIn doesn't allow for it. If it's a Shopify app, there's still a platform risk, but Shopify is working on growing that ecosystem. So there's still a platform risk, but maybe a smaller one. And so there are lots of things that come into play. And funnily enough, a lot of founders reach out to me and say, hey, this is my revenue, this is my growth, what's my valuation? But ultimately, it's hundreds of things that come together and ultimately define your price.
Yeah. So given, let's say their headline numbers meet the targets that you guys look for, of these various things you just mentioned, tech debt, capital efficiency, how clean the organization is run, culture, et cetera, is there one, or are there one or two that stand out as the ones that primarily are the first things you decide, okay, we're not going to go any deeper here?
For us, it's something I didn't even mention, or it's maybe included in numbers, but that's actually churn. So I saw businesses that I wouldn't even call them SaaS, because it's basically one-off, and you're trying to call it SaaS because people stay for 2-3 months. That's not something we would buy, because I mean, there's a high risk that those businesses just start to flatten out once you struggle to acquire new customers. Another big risk I also didn't mention is customer concentration. I saw multiple cases, even this year, 50% of revenue coming from just one customer, or top 3 customers are maybe 40%. That's something where we would definitely not apply a typical multiple on the total revenue maybe and discount it, or we would walk away because it's just too risky. And a third thing I also haven't mentioned is if there's a lot of employee turnover, because that also doesn't speak for the company.
Yeah. Okay. Interesting. So, I've looked at some of your recent posts on LinkedIn, and you talk a lot, and I believe appropriately, about the need for founders or leadership teams to kind of work on becoming exit ready.
Yes.
Sort of from the get-go, right? Instead of waiting till the last minute. And I think the way some of that manifests itself when people are not exit ready is their data posture is just very weak. So, you'll ask for a bunch of information, and it may take weeks and all kinds of unnatural acts to try to pull stuff together. Talk to me about what you see in that area, the maturity of their data posture, not just financial data, but in a SaaS world, their go-to-market data is such a sort of a leading indicator of what their financial data is going to be. How you react if that isn't very mature.
Yeah, I mean, you probably also came across a lot of setups over the decades. You've been an entrepreneur and CEO yourself, but especially those smaller bootstrap ones. I mean, the typical scenario is those are indie hacker type of founders. They coded on the side while having a full-time job. At some point, it started to generate some revenue. They jumped over and did it full-time, but they were never like necessarily analytical people, were strong with numbers. And so a lot of what they did was gut feeling, because they were trying to solve their own problem first and find some other ones that had the same issues. And so you would be surprised what I get sent sometimes. And I always ask the same, like, basic stuff in the beginning. It's just a simple income statement, a forecast, and customer and revenue movements. That's it. And like, I would say at least half cannot provide it. I would say even more. And then also, like, the funniest thing was I asked for a profit loss statement, and was basically an Excel document with revenue, costs, and then profit loss. So it was 3 lines, no cost items, nothing, not the typical SaaS structure, no cross margin, just those 3 lines. Sometimes they sent me screenshots from something they've built in Excel, Google Sheets, or whatnot, but the data poster is usually very weak. And I mean, I keep preaching that on LinkedIn, that people should just like keep some basic data available for buyers, because you might just lose out on exit opportunities if it takes you weeks to prepare it, if you say you don't have it. And this is even basic stuff. And I mean, for more complex data, to be honest, very often they don't track it. Like, marketing is running on gut feeling. They do a bit of SEO, don't know what it brings. They have a budget for ads. They also don't know what it brings. So it's really, surprising sometimes how those companies got this far.
How often is the P&L cash basis instead of accrual?
Very often. Very often.
Because I mean, I've done, we've looked at a lot of different businesses, both here at scaleMatters and elsewhere, and particularly here at scaleMatters, where a number of the targets we would look at are services companies, bootstrap services companies. I mean, they're almost always, and I understand why, operating on a cash basis, but it makes it very difficult to sort of translate that into what a recurring revenue stream actually looks like, and that sort of thing.
Yeah, it's very often a due diligence discussion, and also about the deal terms itself, because I mean, it influences the valuation, because you cannot say, hey, your revenue is X, and I mean, the service period is basically in the future, and we incur the costs for it. So we need to basically correct the profitability of the business, lower the valuation, educate the founders on what's wrong and why all of a sudden this happens, and why we could not continue going on a cash basis. So it happens quite often, especially with those smaller ones. At some point, many switch to deferred revenue principle. But the problem is also many use an accountant that's like a friend of a friend, or someone they found online. They're not familiar with the SaaS model, how it all works. And so, it's obvious that they start on cash accounting.
So given the poor data posture of most of these companies, we had a previous guest, Kelly Ford from Edison Partners, that said, and they do much later stage stuff, but she explicitly said, when we see sort of very immature data posture, we correlate that with execution risk, right? It tends to mean that maybe the leadership team isn't mature enough to have focused on building this stuff out, which means they probably don't know all the levers they can push to run the company properly. And so she said that absolutely impacts how they construct valuation. I'm guessing at the stage you guys operate, more companies have poor data posture than great data posture. How does that impact your view of execution risk and therefore valuation?
Yeah, the good thing is it can also represent an opportunity for a buyer. So, I mean, if we are being egoistic, like if someone cannot provide proper data and they don't even know themselves how their business is doing, that's a negotiation lever for us and not for them. So they might lose out on exit value there because they don't have a proper data posture. It depends. We've also walked away from deals where they couldn't provide proper data over weeks, so we requested it over and over again because ultimately SaaS Group is a serial acquirer. We want to do multiple deals. If we need to wait for 8 weeks, even if it's an interesting opportunity, we might just turn to the next one. And with those that have great data quality, you're right. I mean, it's a good indicator that there's a proper management in place. They know what they are doing. They are data driven. But at the same time, what I said earlier, it can also mean there's not a lot of value add for us because they also already know a lot of things. And yeah.
Right. So the value creation that you guys might bring to bear in that case is less obvious than for the companies that obviously are sort of immature. Interesting.
Yeah, but maybe one additional comment on that. Very, very often founders learn about issues in their business from us for the first time, which definitely shouldn't be the case. So for example, hey, did you see that your new MRR is trending down for the last 12 months and stuff like that? And they still see the overall MRR maybe growing, but maybe growth has decreased, but the underlying trend has been visible for even longer. Or we had one case where they did a price increase just before seeking an exit and running a process. And you could clearly see that they kind of lost product market fit because yes, it gave a bump for the revenue, but you could see that this cohort, like the new cohorts, is much smaller, tends to have higher churn, etc. So how can you do proper price increase if you're not tracking the data properly and you know what's happening once you do it? How can you run a GTM motion if you're not knowing, is this profitable? What kind of ROI do I have on those? I mean, I'm an analytical person, so for me, it's like, how can you get to 5 million ARR just based on gut feeling? But it seems it's possible.
I want to go back to a prior point because we were talking about maybe how data posture or data maturity impacts valuation. But I just want to highlight a point that you made, which is it also impacts potentially whether you even get considered or not. Because I think what you said is you have a certain cadence when you guys determine you're going to look at a deal. There's X amount of time and energy you want to put into that. And if it's just too hard and takes too long for companies to pull the data that you need to be able to properly evaluate the company, you're just going to move on, which I think is kind of an interesting point that I've never heard people say before, but it makes a ton of sense to me. I mean, at the beginning of the discussion, you talked about a mistake founders make is being too distracted, mostly by sort of all the hype stuff and the investor stuff, et cetera. And instead they should focus on selling their product to customers, making sure they got product market fit, yada, yada, yada. So this notion, though, of when to invest in a proper data posture, because you could say at some point that's a distraction as well, right? When you're still trying to figure out product market fit. I mean, certainly data can help, especially like call recording data and stuff like that. But when is the point in your mind that you say, okay, you're far enough along that starting to build out an operational data set that really helps you move from operating on gut and intuition to being data driven and being exit ready? Is there a particular rule of thumb, Dirk, that you would advise founders on there?
I would say it has multiple levels. So I think it helps to start early on because, I mean, as you said, it might be hard to catch up with it at some point and do it from scratch, because then it's also distraction. To maybe take another metaphor here, I talked to a few founders that rebuilt the whole platform 10 years in, basically, and it distracted them, and revenue growth suffered a lot because basically all of the devs were working on rebuilding the platform and not on maintaining the legacy platform. And the marketing team was also like had some difficulties because they were planning to sunset the old one. So you could take this also on the data stuff. It's just hard if it's not a kind of a mindset of yours to at some point say, hey, okay, I just hire a CFO or someone to help me or chief revenue officer, whatever. who has done it before and helps me like build that up from scratch. I wouldn't necessarily recommend it. And again, I would say there are multiple levels in the early stages. Maybe it's not that important to have like super deep granularity. As you grow, you can adjust, you can add more KPIs, you can do it on a more granular basis. I wouldn't even say that those businesses we look at like 2, 3, 4 million necessarily need like super granular stuff and in-depth information about what's going on, but at least like a basic KPI sheet is something I would expect.
Would you expect those companies, 2 to 4 million, let's say, to have a good handle on their new logo acquisition funnel, kind of conversion rates, top of funnel, middle funnel, bottom of funnel? Would you expect them to have a really good understanding of that and broken down by industry vertical or by channel or something like that, or not necessarily?
Not necessarily. I think if you're VC backed and if you're forced to grow exponentially and there are high expectations on you, then yes, because then I think you need to really know what's happening and where to put your money or your VC fuel on. So I think in this case, yes, it could already be super important at 2 to 4 million. For a bootstrap business that's been run more like a, let's say, lifestyle business, high EBITDA margins. So basically you have a safety margin, you have patience, you're not chasing any growth goals, then not necessarily. I mean, it helps. So the thing is with our target group, especially those smaller bootstrap PLD companies, they start to hit a plateau at some point. And why is that? Ability of the founder, whatever. But the big point is also they don't know what's going on. So it starts to flatten out. And if they would look under the hood and maybe have a proper data posture, then they would see, aha, this is the reason. In a cohort analysis, like after a couple of months, people start to churn or a lot of customers don't get activated properly, whatever. But if you have a great data posture, it can help you get further than you would without. And so it's an opportunity for us. We are ultimately acquire those companies and build it ourselves in-house. But maybe you would have grown your company to 6, 7 million instead of 3 by knowing all those things and acting accordingly.
So that's very interesting. You're basically saying you want there to be enough data and visibility to give you as a potential acquirer confidence that we can grow this business. But you actually also want it to not be so mature that you don't have the opportunity to add, exponential value by professionalizing the way the company's run, type thing.
Yeah, I would say it's nuanced. It really depends on the kind of business we would be looking at. But I mean, I would say almost 100% of the businesses are not at the level where we would bring it to, because we have an in-house BI team and they build like the dashboards we want. We have an in-house marketing team, so they overlook all of the marketing campaigns and what's happening there. And I think these are really our muscles, which we developed over the last few years. So I think it will be hard for a small SaaS startup to get there unless they have a data team in-house or a dedicated person taking care of this, which they usually don't. So I don't expect them to have this depth of data and this great data posture. But I think like still, even if it's not that great, you can get further than most of those companies are getting. That's at least my opinion. Maybe I'm wrong, but that's what I'm seeing.
The data maturity or the quality of the data posture of a company sort of shows up in its ability to readily present, normally required KPIs and that sort of stuff. But the underlying issue tends to be that they haven't actually instrumented their environment, right? So they haven't actually set up their tech to measure the stuff in a way that they could. They don't necessarily have processes to ensure that there's good data hygiene. So I'm sure you've seen, you look at some of the CRM data at these companies you look at, and it's just so much inconsistency in the way they do stuff. So the data that exists is just such poor quality that it's hard to extract high confidence KPIs out of it. When you or others, on LinkedIn or other places are talking about this stuff, it's often in terms of the dashboards or KPI, basically what you want to look at. But the plumbing, the work that needs to go on in the plumbing to actually produce that stuff it isn't often talked about. Have you seen any companies where you thought, at the stage that you guys look at, where you said, these guys just blow me away in terms of how good they have instrumented their environment, how disciplined they are, particularly the sales leader, in having their salespeople follow processes and stuff like that?
Yeah, since we are focusing on PLG, I'm not talking to many sales-led businesses, but
right.
I've definitely seen a few. I wanted to bring one example. It's a company we acquired, and maybe it's because of the space they're in, but they're actually offering a QuickBooks integration with e-commerce platforms. So they're synchronizing data from accounting platforms to e-commerce platforms, and they are very good at numbers. And it was, I think, the fastest transaction we've ever done. They got some help, admittedly, so the founder didn't run the process on his own. But basically, it was like, okay, we signed an NDA. Here's all the data. It was well structured. Everything was there. We looked at it. We understand what's happening. We could provide evaluation quickly. We agreed on terms. Boom. Went into due diligence, closed the deal. And so this ideal case scenario, I think the deal was done in less than 100 days from really having the first call to ultimately signing the deal, which is quite fast.
Yeah, it is.
No real relationship building, actually. It was just like they were looking to sell, they had everything ready, and we could close quite quickly.
Okay, so that goes back to your prior point about if it slows down your cadence, you guys could eventually walk. But in this case, you're basically saying if somebody really got their act together, you could get to closure, which in itself reduces risk of exit, right? I mean, we all know that time kills all deals, right?
Yes.
So I think that's a very interesting point.
And I have another example, a company we're currently talking to. I mean, I can't mention a name, but they have a low ARPU product, and it's been around for, I think, 7-8 years. And they are selling basically product for less than $20 a month. And they have thousands of clients. And over time, they adjusted pricing. Then they gave out some discounts. Then they run some Black Friday campaigns and whatnot. And they provided us with billing data. And there were basically like hundreds of different, I mean, I'm exaggerating, but so many different pricings and so many different amounts customers were paying. We didn't even know, like, why are they paying less? Why are they paying more? And so it takes basically weeks to understand what's happening. Like, what are those cohorts? Why are they paying less? What are the dynamics? Have they higher churn, lower churn? What's their retention? What can we do going forward to streamline it? So the more complex it is and the deeper we need to dig to understand what's happening, the lower the probability that we will ultimately get a deal done.
Now, that makes a ton of sense. So let's switch gears real quick here at the end. Any books or podcasts or other resources that you would recommend to founders or other people that are sort of focusing around in the go-to-market space that are looking for practical insights that they can take into work right now?
So first of all, I have to admit, I learned about your podcast only a few weeks ago, and then in preparation to our session, I listened in a few episodes, so I can definitely recommend yours. And also previous sessions, super interesting also for me, like lots of new learnings there. Actually, because you sent me some of the questions already, what I can recommend, because I also had to learn like those KPIs from scratch. I'm coming from mechanical engineering. Was this book called Lean Analytics? Maybe you've heard of it.
I
So
have.
It just shows the basic of different business models, like how does e-commerce work, how does SaaS work, what kind of KPIs are being measured, and how can you get a better understanding of what's happening in your business for the basics. And I mean, I encourage you also to follow some SaaS finance leaders. I mean, Ben Murray, maybe you've met him before.
Yeah.
I also learned a lot from him. I personally don't like books that much because they're kind of static. So you read them and basically a new one comes out next month. And so I tend to read a lot of blog posts, listen to podcasts, because then you're always up to date. And you learn basically the latest stuff.
Hey, Dirk, I've appreciated this conversation. I think you've provided a lot of insight that could be valuable to founders, particularly on the data aspects of exit readiness and some of the risks involved in being able to exit or get deals done if your data posture isn't where it needs to be. So thanks so much for coming on the show. Thanks for sharing your insights, and again, appreciate it.
I really enjoyed the conversation. So thanks again for having me. I hope I will provide some helpful insights, and if there are any follow-up questions on this and how to prepare for an exit, what kind of data we're requesting, I encourage listeners to approach me and just ask questions. I'm happy to help.
And how can they reach you?
I'm an email person, Dirk at saas.group. Actually, my LinkedIn inbox is a mess, and it's hard to catch up. So Dirk at saas.group, but you could also try where LinkedIn might take a bit longer for me to get back.
Cool.
Yes.
Thanks again, Dirk.
Thanks, Scott.
Make no mistake, good data matters for driving efficient growth and valuations. Follow me on LinkedIn, where I'm sharing insights from CFOs, investors, and strategic go-to-market execs. Thanks for listening to The Data Room.